Rate cuts began in the U.S., yet the dollar didn't collapse. Here's what actually drives USD today and what it means for the months ahead. On 17 September, the Fed cut rates by 25 basis points, bringing the federal funds rate down to 4 to 4.25%. The statement and projections left the door open to further cuts, but only if justified by the data. At the press conference, Powell cooled expectations of an aggressive path, and the dollar, after its initial drop, reversed course. The rebound was also supported by macro data that beat analysts' forecasts, such as core capital goods orders, the component of durable goods that tracks business investment in equipment, excluding defense and aircraft, which rose by 0.6% month-on-month in August. Rate differentials are narrowing. The gap between expected rates in the United States and the rest of the G10 is shrinking. In September, the Eurozone, the United Kingdom, and Japan left policy rates unchanged. European Central Bank at 2%, Bank of England at 4%, Bank of Japan at 0.5%. For 2025, markets expect widespread cuts, deeper and more numerous in the United States than in other G10 economies. The Fed Watch tool makes this clear. According to futures, another 50 basis points of cuts are expected by year-end. That means the yield advantage of the dollar will continue to erode, creating structural pressure towards weakness, especially against the euro and the yen, as I will explore in the second video. So far, that's the backdrop. The Fed has delivered its first cut. In the following hours, Fed funds futures rapidly priced in a higher probability of further cuts, only to pare them back later. The dollar, after the initial dip, recovered, supported by some data that came in stronger than expected. Now the key is to understand which direction the dollar might take in the coming weeks and what factors will drive its moves. Let me start with a Bloomberg chart on the dollar index cycles, which captures the current phase very clearly. The third multi-year cycle has entered its downward leg, and in the coming months, the dollar is expected to weaken further. The two previous cycles, in the late 80s, 90s, and between 2002 and 2011, both ended with multi-year declines. The signal here is that we could be at the start of a similar dynamic. If you are enjoying this video and want to learn how to analyze the Forex market correctly and comprehensively, you can find all the key concepts explained step by step in my book, Forex Fundamental Analysis, The Essence of Forex, available on Amazon. Link in the description. Now, let's get back to the video. Enjoy! Amid all this, interest rates will play a decisive role, and they, in turn, will depend on the health of the United States economy. On the consumption side, the picture remains mixed. Core PCE, the inflation gauge the Fed considers most representative, hovers around 2.7% year-on-year. It's no longer explosive as it was a year ago, but still far from the 2% target. Prices keep rising, especially in services, while the monthly trend shows sticky inflationary pressures. American consumers are still spending, but increasingly by dipping into savings. The personal saving rate has fallen below 5%, signaling that demand is still there, but becoming less sustainable. In August, consumption rose by more than $129 billion, led by services such as transport, healthcare, and restaurants, but also by some categories of durable goods. Demand hasn't collapsed, but cracks are beginning to show. Consumer spending is one of the last pillars holding up the United States economy, and if it gives way, the dollar will feel it. On the labor front, conditions have weakened. In August, unemployment climbed to 4.3%, with only 22,000 new jobs created, and it's not just about the numbers. Cyclical sectors, those most tied to the economic cycle, saw the biggest losses. Manufacturing shed jobs, wholesale trade declined, and even oil and gas extraction cut staff. Defensive sectors, like healthcare, held the line. But the message is clear: the sensitive part of the United States economy is slowing. If this trend continues in the September and October data, the Fed won't be able to ignore it. With shaky consumption and cooling employment, the narrative is shifting. The dollar may no longer have the same support it has enjoyed in recent years. Beyond inflation and jobs, another key driver of the dollar is yields, particularly the spread between United States 2-year real rates and those of other developed economies. When the gap narrows, rival currencies tend to gain ground. When it stays wide, the dollar keeps its edge. Relative growth also matters. Who is performing better today and who will perform better in the coming quarters? If data outside the United States stabilizes, other currencies regain credibility. If the United States keeps showing resilience, the dollar stays in the lead. And finally, there are global flows and risk appetite. In times of stress, the dollar remains the ultimate safe haven. In calmer times, it tends to ease, leaving room for other currencies. This is the channel through which geopolitics, tariffs, and sudden shocks have their impact. These three, yields, growth, and flows, are the structural drivers of the dollar. Keep this framework in mind going forward. In the next video, I will examine them more closely in my analysis of Euro-US dollar and US dollar JPY. Thank you for watching this video. If you have questions or thoughts, drop them in the comments below. See you in the next video.